we do a soft credit pull. So I think as I watched when you profiled our company on your YouTube channel, you were right in indicating that we don't affect a customer's credit score by applying, because we just do a soft pull. We like to think of ourselves, I know that the catchy phrase is like fintech, and it's a great word and all, but we really see ourselves as a tech-enabled lender. We like to call ourselves that instead, because we are a lender first and foremost, and we use our technology to try to do these things fast and efficiently. In the small business world, if you don't do things quick, there is a competitor that's going to come in and do it faster and better, no matter what.
And in today's video, we have a special guest. We have Justin Lito, CEO of Idea Financial. Pleasure to have you on, Justin. Definitely appreciate taking time out of your busy day to speak with us. I know a lot of our subscribers have a lot of questions that they wanted to just have addressed in terms of Idea Financial, what Idea Financial is, and what you guys have to offer. So definitely a pleasure having you on. Welcome to the channel.
No, thank you, Antoine. It's very impressive what you built here. We're excited to be speaking with your loyal following.
So let's jump right into it. So tell the subscribers a little bit about yourself, your background, and where Idea Financial kind of fits in the overall business lending landscape.
Sure. So I'm actually not from the space, which I think adds to the story a little bit. My business partner, Larry Basuk, and I, we started Idea Financial after practicing law for about 18 years. So we come from way outside the financial services sector. We happen to be involved with some folks through representation that have some banks and some overseas interest in lending. And they gave us an opportunity to start this company here in the United States with some good funding. So the idea behind Idea Financial was really to try to find a niche in the market that was being underserved. And we did a bunch of research before we started the company. And what we realized was that while there are many good companies that provide term loans, merchant cash advances, and other more standardized financial products, there wasn't really anything outside of the banking sector that was a true revolving line of credit, so that businesses could have more flexibility with borrowing. So that's really what we set out to do this was back in March of 2017. And, as we iterated over and over over the last 5 years, we feel like we built a pretty substantial business offering to merchants now something that they couldn't get before, which is that flexibility that a revolving line of credit provides.
Let me ask this. So in terms of like borrower characteristics, right, is there a particular type of business that kind of fits into Idea Financial's business model? You have your traditional commercial banks, you have alternative lenders. How would you kind of characterize like the ideal business in terms of like data points, time in business, revenue, credit quality? What would be sort of like the minimum threshold?
So we like to think of our clients as bankable, so to speak. I know that there's, the word bankable is sort of ambiguous, but I think that most of the folks that are Idea Financial customers, if they had the time, the energy, or the patience to go through the process of applying for a bank loan, they likely would be able to get it. And again, that's really what we were going for. So the customer is a more prime guarantor as far as the owner of the business. The minimum FICO is 650. You have to be in business for at least 2 years. So we're not really doing the startup business. And while the minimum revenue sits at about $200,000, most of our borrowers have substantially more revenue, mostly in the low seven figures. And as far as industry is concerned, we cover pretty much the spectrum. We have a couple of industries that we won't fund, and that's more for like the risk guys to address. I'm not sure exactly what they are off the top of my head, but we cover pretty much everything, Antoine, from the barbershop and the pizza shop to the commercial warehouse. Anything that you can think of on Main Street or that supplies to Main Street. And also, interestingly, because my business partner and I are both former trial lawyers, retired and reformed trial lawyers, so to speak, we have another brand that comes under the Idea Financial umbrella, which is behind me. You'll see that superhero, that's Level-esque. Level-esque is specifically tailored just for plaintiff lawyers and trial lawyers, like I used to be in my former life. We found that a lot of lenders sort of exclude lawyers from the borrowing area. I don't know why, but they don't want to lend to lawyers. So we've opened up what we think is a pretty competitive product to try to fund lawyers and law firms on the platform.
So is like I've seen previously with other companies where they might sort of provide an advance to plaintiffs that might be going through some type of class action and, just a way for them to get funds. Is that kind of similar, or is this a different type of financial product?
No, it's actually quite different. So what you're talking about is a very popular product. You're talking about plaintiff funding. And what that is, just so your listeners and your viewers understand, when somebody sues someone else, oftentimes the person who is filing the lawsuit either has a backup in the ability to earn money because they're very badly injured. They have very high medical bills. So there are a lot of companies that will advance those folks money while the lawsuit is pending. That's not what we do. That's a great business, but that's just not us. What we're doing instead is those lawyers that represent those victims of whether it be medical malpractice, premises liability, auto accident, product liability cases, those lawyers are advancing all of the costs before this case ever gets to trial or is settled. So those can get pretty expensive. In my experience, when I was practicing law, an average medical malpractice case would cost me, in the six figures before I ever had any guarantee that we were going to get a final result positive for the client. So what we do is we provide insurance for those lawyers so that if they lose their case at trial, they can get all that money back. But more importantly is we provide loans for the plaintiff lawyers at a very reasonable rate so they can finance those cases with our money instead of theirs. So that way they don't lock up all their money for a long period of time while the case is pending, and they can use their own cash to either build a practice, hire new people, and they can use our money, which is paid interest only, for the life of the case. So it really is sort of a novel approach to plaintiff lawyer funding. And it uses the very same framework that we've built with the small business lending. We like to think of ourselves, I know that the catchy phrase is like fintech, and it's a great word and all, but we really see ourselves as a tech-enabled lender. We like to call ourselves that instead, because we are a lender first and foremost, and we use our technology to try to do these things fast and efficiently. In the small business world, if you don't do things quick, there is a competitor that's going to come in and do it faster and better, no matter what. It's a very competitive landscape, as you know. In the lawyer lending world, the amount of time and effort it takes for a lawyer to get a loan is incredible. It's weeks, months. They have to pledge their home as collateral. They have to buy life insurance. We remove all of that, and we've built for the small businesses to also help our colleagues really in the plaintiff's bar. So it's a pretty exciting new product, and it really covers it all the areas now on the small business lending side.
I wanted to back up and go over the overall life cycle of the Idea Financial term loan as well as the business line of credit in terms of the processing, kind of what that whole process looks like from initial application through funding. So could you elaborate a little bit kind of on the life cycle at each step? What does that look like from when a customer submits an application through when they ultimately get funding? What are the different layers within that?
Sure. So we try to make it as seamless as possible, but I'm always the first one to say that there are human needs for lending. So we don't do everything through automation. I personally, as a business owner, think it's a mistake to rely on a computer for everything. And I can explain a little bit as we discuss this, but we have everything online as far as the application process. And it doesn't take a lot of information really to make a credit decision. It's really a name, social security number, EIN. We do a soft credit pull. So I think as I watched when you profiled our company on your YouTube channel, you were right in indicating that we don't affect a customer's credit score by applying, because we just do a soft pull. And once we get all that information, a merchant has two choices. They can either provide us the physical bank statements, which has always been the traditional way it's been done in the past, but we also use an integration platform called Finicity. It's a competitor of Plaid's. I think it's owned by MasterCard at this point. And so Finicity is a reader basically that allows for us to pull that data. We know it's secure. We know that there's no fraud involved in the statements. We process that through a third-party processing system that can give us lots of information about revenue, about deposits, about whether they have other loans. And that really helps us make a credit decision very, very quickly. So through like the perfect path where all the information is provided and the bank accounts are linked, we can get an offer out to a merchant within 30 to 45 minutes. Now, we do have stipulations that we ask for in some circumstances. For instance, if we're unable to identify the merchant through the Secretary of State, we may want documentation to show that they're in good standing. That's one thing that sometimes happens. If we find a non-revenue deposit in the banks that's likely from another lender, we want to know the terms and what's going on with that loan. So our human underwriters take over. They ask for certain information just to solidify the offer, and then the offer goes out. And the way that the product works, again, we try to make it as simple as possible and as flexible as possible. Whereas with a term loan, all the money is sent to you one shot. You get approved for 100 grand. That's what you're getting, whether you need 100 grand or 15 grand. With the revolving line of credit, to the contrary, you can take only what you need, and you can take it on a revolving basis. So it's much more as a needs-based product as opposed to us throwing it all at you at once. And we think that makes it safer from a credit perspective, and more friendly from the user's perspective.
Does a borrower have to specify whether or not they want a term loan or line of credit at the time of application, or is that something that they can choose once they actually get an approval if they want to go with the line of credit or if they want to go with the term loan? And is there different underwriting criteria for either of those products?
So to answer your second question first, the answer is no. The underwriting criteria, as far as what we look at, is the same. As to whether they have to choose up front, the answer is also no. Typically what happens is our underwriting system will spit out both a line of credit and a term loan offer. The line of credit, again, it's different on a case-by-case basis, but speaking pretty generally, the line of credit tends to be a little lower on the offer amount because of the revolving feature, because you get more. If you have a $100,000 line of credit, you can borrow $200,000-300,000 if you revolve it correctly. Whereas, as you know, with the term loan, you get the money and you pay it back over a period of time with a defined factoring. So my opinion is that if somebody has the choice between the two, I don't know why they would go with the term loan, but because the market is used to the term loan, at one point in about a year and a half into our production, we decided that it would be in everybody's best interest if we at least made it available. It's also a lot to do with some of our partnerships with brokers and ISOs who are also used to selling the term loan more, because if the line of credit is a little bit different to sell than the term loan. The terms are different. The way in which it works is different. It's not super complicated, but if you're used to selling one particular product and then you have to sell a different product, you may just immediately defer to the one that you already know how to sell because it's just easier to get out the door. So we wanted to give that optionality, not just to the merchants, but also to our partners. But for somebody who's coming to us direct, our sales team would likely point out the benefits of the line of credit because that's our preferred flagship product. But if the term loan offers a little bit more money and that merchant is needing it right now for a piece of equipment, then it might make more sense for them to go down that route.
Absolutely. And I talk about that a lot on the channel, just like some of the distinctions between like a line of credit or term loan. If you have an immediate need for the funds, then the term loan might be a better option. But if it's just something where, you may not know today how you're going to deploy that capital, the line of credit is going to provide more flexibility. And then the other question I wanted to follow up with in terms of the rates for both the line of credit as well as the term loan. Now, I know just from some of the documentation I read up on, there is a draw fee when you draw down on the line of credit, and there's a minimum amount that you can draw down at each time. Can you elaborate in terms of like how that works, right? So are those draws treated like separate loans and have separate terms?
No, they're not. And that feature is what I think defines the difference between us and some of our competitors that claim to have a line of credit.
Right.
So this is really a line of credit. So when you take a draw of $10,000 today and $20,000 in a month from now, the way that it works is you take that $10,000 draw. That draw is amortized over whatever the repayment period is. And our repayment periods vary between 12 and 36 months. And again, the 36-month repayment period is also fairly unique. It's a longer term repayment than most of our competitors, which holds the cash flow better for the merchant because the payments are. So you have that initial $20,000 draw, let's say, for instance. That draw is amortized on your payment schedule over the payment period. Let's call it 36 months. In 2 months from now, let's say you paid down $2,000 of that principal. So now you have an $18,000 balance. And again, I'm just kind of making up numbers. These are not real. Then you want to take $25,000. You take that $25,000, you would add it to the current principal balance, which is at that point $18,000, and you now have a $43,000 balance, which on that day of that second draw is re-amortized over another 36-month period. So you're not stacking loan after loan on top of each other. You're sticking with one payment that you can rely upon. That payment will change depending on how much you're borrowing, and the amortization period will reset each time we approve a new draw. And again, that's the flexibility aspect of it that really we think is good for retention of the merchants and allows them to plan ahead as opposed to paying like 2 or 3 different payments a month or a week even for multiple loans.
I am familiar with other products out there, and it kind of works the opposite way where, each draw is treated like a separate loan. In my opinion, that's not really helpful in terms of a line of credit because it's basically like just multiple loans that you're taking out. But is there a major difference between the interest rates of the line of credit? in the term loan? Because I know the line of credit does have the draw percentage, right? Every time it's drawn down on, and then on top of that, is it all? You also have the regular APR. Is that correct?
That's right, but it's not a factor rate. So it's an important distinction. A term loan has a factor rate, and I'm sure you've probably explained this to your viewers multiple times, but just for point of clarity, a factor rate is the amount of money that you have to pay back, regardless of when you pay it back. So if you borrow $100 and you have a 1.25 factor rate, you owe that lender $125. So even if you pay that loan back early, for the most part, you're going to owe the same amount, which sort of explodes your interest rate if you look at it. It sounds very reasonable up front, but when you really look at it as a sophisticated business owner, it never really is the best option. Whereas the line of credit has a couple of features that are much better for the purposes of a merchant. Number one, it's a real interest rate. It's not a factor rate. So it's a fully amortizing loan. Every day interest accrues at the rate. Every week or month, depending on the payment frequency, you repay a portion of the principal based on the amortization schedule and whatever the outstanding interest is. Then if you choose to prepay the loan, there's no penalty. So you can save all that interest expense by paying the loan off early. Once you pay the loan off early, you can continue to reborrow, which gives you all that borrowing capacity. The draw fee, it varies. It depends a lot on credit quality and channel from which we get the loan. It varies from 1.5 to 2.9%, but it's not paid up front. It's amortized as part of the loan balance. So if you draw $50,000 and you have a 2% draw fee, then you'll get $49,000. And that $1,000 will stay within your loan balance as part of the amortized draw amount. So it really, again, it gives a lot of flexibility because you're looking at an actual interest rate similar to a home mortgage or a car loan, where if you pay it sooner, you pay just less interest, as opposed to the term loan, where it doesn't matter when you pay it, you're going to pay the same amount back to that lender. For merchants who take term loans with Idea Financial, again, it's their choice. It's never the recommended path, but we always give them the option to convert that term loan into a line of credit at some point during the life cycle of the loan. Typically within 3 to 6 months, they'll get a call from someone on our team, not encouraging, but asking if they'd like to convert it, because the conversion makes more sense for them. And what we do, instead of charging the full factor rate, we reduce that by 50%, so they don't get stuck with that full repayment on the factor rate, and then they can convert the loan into a line of credit so they can then use it over time.
Definitely appreciate all the insight you've been able to provide. I know you definitely answered a lot of questions, even some that I received from some of the subscribers since our last review. Are there any parting words that you wanted to share with the subscribers before we wrap this up?
Well, the one thing I'll add, and again, I appreciate you having me on. When I was watching your channel, I was so impressed by how many people you've managed to reach. I think it's great to be able to reach people organically like this to provide information. So you're offering a really important service. It's important for every borrower or potential borrower to understand that companies like ours are much more like them than we are perceived to be. So I know banks and financial institutions, they may come off as being these behemoth organizations that run like a huge bureaucracy. I can only speak for Idea Financial because that's the company that I run, but we are very much a small business, very much like all of our clients. So we really understand a lot of what they're going through. Specifically during the pandemic, I spoke myself personally with hundreds of our customers because we really reached out to every single one of them to see what we could do to help. And I think they realized, the people that we spoke to, that we were going through very similar struggles that they were. No one really knew what was going to happen. We employ right now about 45 people, so we're not a huge company. It's very tightly held. Everyone works together to try to make sure we're delivering the best experience for our clients. So when they come to Idea, I want them to understand that they are coming to another small business that understands what they're going through and isn't just some stranger that's loaning them money on the internet. We try to develop to the best ability that we can a relationship with the folks that
you have a lot of fintechs, you have a lot of online banking. You kind of lose that personal touch. So I definitely appreciate the fact that you guys definitely incorporate that within your business structure. If anyone's interested in applying for a business term loan or business line of credit, we've dropped links in the description of the video. Again, Justin, definitely appreciate you coming on our channel, and hope to have you back on at some point. But until next time, take it easy, and we'll talk to you soon.
Thank you, Antoine. Really appreciate it. Happy holidays.